This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be showing you how you can perform a discounted cash flow analysis on a company using my discounted cash flow calculator. You can find a link to my calculator in the video description. I've previously made a discounted cash flow calculator on dividend paying stocks. So if you want to analyze a company that pays out dividends, you can use that calculator. But some of you guys did leave me comments asking for a more generic calculator so that you can use this not only for dividend paying stocks but also non-dividend paying stocks. But basically what we're trying to do here, to give you a really brief introduction on what a discounted cash flow model is, what we're trying to do is we're trying to discount the future cash flows of a business to today's value so that we know what we're willing to pay for the company. So this is also known as an intrinsic value calculation for a business. We're trying to calculate what the business is really worth based on its future cash flows. And the reason why we discount those future cash flows back to today is because a bird in the hand is worth two in the bush. Basically what that means is your $1 today is worth more than your $1 tomorrow. The reason being is that you don't know whether you'll still be alive next year, and also because of inflation or other expectations of interest rates and all that kind of stuff, right? Because if you have certainty over your $1 today, why would you wait till next year? And if someone says, I'm going to pay you $1 in 1 year's time, obviously you're not going to pay them $1 today for that $1 in 1 year's time, because what that meant was that they basically got an interest-free loan. So you want to say, I will pay you 90 cents for $1 tomorrow or $1 next year whatsoever. So that's why $1 in the future is worth less than what it is today. And likewise, a company will generate future cash flows that we need to discount to today's value, basically based on our expectations of the future or our required rate of return. Now, I do have to warn you guys that if you put bad inputs into the calculator, you will only get bad answers. In other words, garbage in, garbage out. So the quality of the answer of the calculator will depend on the quality of your inputs. So in today's video, I'm not only going to show you how you can use this calculator, but I'm also going to show you where you can find information to help you build an expectation of the future of the business. And I'm going to walk through an example using Facebook stock, because Facebook stock is one that I own and its results are actually going to be released next week. So I'm just going to recalculate what I think intrinsic value for Facebook is so that I am prepared for that earnings result coming out next week. So if you enjoyed today's video, be sure to hit like and subscribe. But with no time wasted, let's get right into the video. Alright, so over here I have my intrinsic value calculator spreadsheet. So over here I don't have any inputs at the moment, so I'm going to show you where you can find the inputs. But let me talk briefly about the different kind of inputs that you need to enter into the calculator. So the yellow highlight is basically input that is based on different scenarios. So over here I have the worst case scenario, the normal case, and the best case scenario. So the normal case is basically what we think the company will grow at if business continues as normal. And the worst case is a slightly more bearish case if we don't think the company will do as well. And the best case scenario is just our most bullish case of the company. Basically what we're saying is that the company will smash it out of the park and will do a lot better than what it is doing today. So that's the three different types of cases, and the inputs to these different cases will depend on our expectations. So I'm going to show you where you can find information to build that expectation later on. But let's talk about the other inputs over here. So the light gray one is the input that is based on individual circumstances. So there are two gray inputs. So first one is the discount rate. That is the rate of return that you're willing to get. So personally, I usually enter 10%. 10% because I do want to outperform the market, and we know that the market usually returns 6 to 8% over the long term. So I want to outperform the market, so I put 10%. If you are using a particular rate for one company, just make sure that you're using the same rate across different companies that you analyze so that you're comparing apples to apples on a discount rate basis. The second factor that will depend on your situation is the margin of safety. So this margin of safety basically means how much we want to buy below the intrinsic value of the company that we are calculating. So we usually want a higher margin of safety when we're not too comfortable with the quality of our inputs, because if we're not too confident about our inputs, we do want to be a little bit more safe. We want to take a haircut on that calculation and buy in at a lower lower price. So if you're not confident in the inputs that you're entering into the model, then you want to invest with a higher margin of safety. The third one is the light blue color highlights, and that is to update from an external source. So the different things that we'll need to get are the total cash, the total debt, number of shares outstanding, the current share price, as well as free cash flow. And the last one is the light green highlighted ones, and that is an output. Basically, you don't need to touch this because that is all formula driven based on the work that I've done on this spreadsheet. So let's work through these different numbers over here. The first four inputs that we need can be found on Yahoo Finance. So I'm going to pull up a Yahoo Finance page to show you where you can find these inputs exactly. All right, so over here I have the Yahoo Finance page, and I have Facebook up over here. I'm going to go into statistics to find that information, and I'm going to scroll down to balance sheet to find its total cash. So total cash is 61.95 billion, and because I'm going to use billion throughout this exercise, just make sure that the other numbers are in billions as well. So for total debt, that is in billions, so I'm going to add 11.18 billion. So for the number of shares outstanding, go into share statistics, and you can find that number under shares outstanding, 2.4 billion shares. And the current share price is easy. It's the big number over there, 302.24. And that is your first four inputs done and dusted. So the last input that we need is the free cash flow number. And to find that number, I'm going to go to the ticker platform. So over here, I am in the ticker terminal, and I'm going to search up Facebook. And where you want to go is to go into the financials tab. And under financials tab, you want to go into the cash flow statement. So what you want to do now is you want to copy the table and paste this table into your Excel spreadsheet so that you can recalculate free cash flow. And I'm going to show you how you can calculate that right now. So over here, I have pasted the information that I've got from the ticker terminal. And to calculate free cash flow, what I did was I took the cash from operations, added back in the amount spent on capital expenditure, as well as cash acquisitions and the other investing activities. Do note that I don't add in the change in net working capital. The change in net working capital basically reflects how much money is tied up in your current assets versus your current liability. So the more money that you have tied up in your current assets, such as inventory or accounts receivable, means that you have less cash that you can use to invest into the business or to pay back shareholders. And as the business grows, more cash will be tied up in working capital. So that is basically what this number is, but you don't have to worry because that is already reflected into the cash from operations. And the other number that I don't add back into the calculation is investment in marketable and equity securities. So Facebook is a business that generates a lot of cash, and in order to generate a better return than just keeping cash in cash, what they do is they take the cash and invest it in short-term treasuries that pay a higher interest rate than what they'll get putting that money into the bank. So when Facebook takes that money and invests it into short-term deposits, that counts as cash flow going out as investments. So it's not quite really investments in marketable securities like other shares in companies. So what I'm going to do is I'm not going to include that in cash from investing because it's not really cash that Facebook is using to grow the business. It's just them taking cash, putting it somewhere else to earn a higher interest rate. And what I also do is I calculate the CAGR for the past 5 years, or the compounded annual growth rate for the past 5 years for free cash flow. And this number over here is 15%, basically saying that from 2016, cash flow grew at an average rate of 15% per year. All right, so this is just a high level overview of Facebook's numbers, but if you dig a little bit deeper, you can also find more useful information to refine your inputs, because remember, garbage in, garbage out. So the more information that you have, the better. So over here, I have the free cash flow reconciliation of Facebook from Facebook's earnings presentation in Q4 of 2020. And over here, we see Q2 of 2020 having a much lower free cash flow than the other quarters, as well as the previous year's Q2 free cash flow number of $4.8 billion. And if you look at note 1, basically note 1 says that this reflects the $5 billion FTC settlement that was paid in the second quarter of 2020. So if you don't know, Facebook was fined $5 billion in 2019, and they only paid that fine in 2020, which is why we see the free cash flow number for Q2 of 2020 being dramatically lower than the other quarters. So if this was just a one-off $5 billion, then we can adjust to reflect what the business will actually do if they didn't have to pay the fine, so that we have a better reflection of the company's operation going forward. So I'm just going to add back in $5 billion into here so that we get a more clearer or a better input into our model. So over here, I'm going to plus 5,000 over here because we are representing these numbers in millions. So over here, I do have $28 billion of free cash flow now instead of 23 billion, and my growth rate goes from 15% to 19.65%. So as you can see, our input has changed quite dramatically when we get more refined information. So that is what I mean by garbage in, garbage out. So the more you understand a business, the operations of the business, what has happened in the past, the better you can develop your expectations of the business. So coming back to my intrinsic value calculator over here, I'm going to enter a free cash flow number of $28.2 billion because that is a more accurate reflection of the business. So now moving on to our normal case scenario, now that I have an expectation that the business has grown in the past at 19.65%, I'm going to use an even lower rate just to be a little bit more conservative. So I'm going to use 15% for my normal case, assuming that business continues as normal. So I assume that for the next 5 years, and for years 6 to years 10, I'm going to use an even lower rate. So roughly half, I'm going to use 7%. So the reason why I use a lower growth rate in years 6 to years 10 is basically to reflect that the business is growing bigger and bigger, so it is getting harder and harder for the business to grow. And because we're forecasting 6 to 10 years away, there is a little bit more uncertainty. So I'm just going to be a little bit more conservative and use 7%. Now the terminal multiple over here is basically the multiple that we expect to sell the business at the end of year 10 based on how quickly the company is growing. So a company growing at 7% roughly, I'd say will sell at a terminal multiple of 15 times. So as you can see, this is more of an art rather than science because this is based on your expectations of the business going forward. And now for the worst case scenario, I'm going to project an even lower growth rate than the normal case. So what I'm going to do is say 10% roughly to show that the business isn't going to do as well as it has in the past. And for years 6 to years 10, I'm going to use half of that, so growing at 5%. And a terminal multiple of say roughly 12 times for a business growing at 5%. For the best case scenario, I'm going to say the business is doing as well as it currently is doing, so that's 19.6%, and I'm going to say at years 6 to years 10, another 10%, and a terminal multiple of say 18 times. So now that I have the different inputs to the different cases, I have to assign probabilities to it. So now I've assigned 25% for the worst case scenario and 25% for the best case and 50% for the normal case because I do expect the normal case to play out because it is the normal case after all. And what the calculator does is that it calculates the weighted value per share to come up with a blended value based on the probability that you've assigned to each of these cases. And what the calculator also does is that it calculates the cash per share that the company has based on the input that you enter over here, and it also takes out the debt per share as well to give you an equity value per share of $361.51. This number over here is basically what we think Facebook shares are worth because you are buying into the equity of Facebook, so this is the equity value per share. So the next number that we need is the margin of safety number, and as I've mentioned before, the margin of safety number basically reflects how confident we are in our inputs to the model. So in this case, I'm just going to use a 20% margin of safety because that is to say that I'm not too confident that what I have projected is correct, but I'm pretty confident. So 20% seems about right. So at that margin of safety, I get a margin of safety price of $289.22. At the current share price of 302 cents, that represents a downside of 4%. So if I don't have a margin of safety, say if I use 0%, then I think the share price of Facebook at the moment shows a 20% upside to its intrinsic value per share. So that is basically the intrinsic value calculator in a nutshell. So overall, what this is saying is that if you invest with no margin of safety, you are getting Facebook shares at a bargain, and it represents roughly 20% upside if you buy at today's prices, and assuming that you get a 10% rate on return. But if you have a margin of safety of say roughly 20%, then that upside quickly disappears, and it's roughly trading at fair value. So this is what the calculator is telling me, and it also gives me confidence depending on the conviction that I have on the inputs into my model to give me an intrinsic value. So that is the intrinsic value calculator in a nutshell. If you want a copy of this, you can find the link to the spreadsheet in the video description down below. And if you enjoyed this video, be sure to hit like and subscribe. Let me know how you find this calculator, and let me know if you found any undervalued stocks in the comment section down below. I'll be really keen to hear your thoughts. Thank you guys for watching. Until next time, take care.